we'll call our special council meeting of April 25th to order. And the only item that we have on our agenda is our 2015 financial statement. Barb, you'll do the introductions? Mic on?
Thank you. I'd just like to take a moment to introduce Leon Pfeiffer. He's the managing partner for Collins Barrows Accounting, and that's our appointed auditors out of Edmonton. So he's going to speak to you about the financial statements for 2015.
Excellent. Okay, I'm going to present, first of all, thanks for having me. It's nice to be here in person for a change, as opposed to last year. Had a little health issue last year, but glad to be back. I sent out 2 documents. Hopefully, you've had a chance to read through them. The first one, obviously, is the draft audited financial statements, and then the second document is our official report to council with respect to the audit. I often refer to it as our final audit findings memo. It is a requirement under Canadian auditing standards to talk to you about certain things such as independence and your accounting policies, whether or not we discovered any fraud or error within the scope of our audit. So we'll get to that document in a minute. Again, I'm not going to go through every page. If you have any questions, just feel free to ask them. I'll try and answer them here. I don't have my detailed working paper file in front of me, but if you have a question that I need to refer to that file, I can do that after I leave here today and send out an official memo or email to all of you, just so you have that for your record. Okay, we'll pop into the statements. First page is just, this is just management's responsibility for the consolidated financial statements. This is really just an insert that goes into the statement, and obviously management will sign off on this, just indicating or making it formal that the financial statements, of course, are the responsibility of management, and we provide the audit report within those financial statements. This is our contribution to your financial statements, as it's titled, the Independent Auditor's Report. You will receive, the town is getting a clean audit opinion, so there's no qualifications within this audit report. And you'll see that under our opinion paragraph there right at the bottom. Basically says, in our opinion, the consolidated financial statements present fairly in all material respects the financial position of the town of Drumheller as at December 31st, 2015, and the results of its operations, changes in its net financial assets and its cash flows for the year then ended in accordance with Canadian public sector accounting standards. Again, your financial statements are prepared in accordance with a separate handbook referred to as the Canadian Public Sector Accounting Standards. There was one other small paragraph there, a little bit of a change this year. We just wanted to make a little more explicit in the financial statements that the budgeted information that's contained within these financial statements, we don't audit the budget. We just simply drop the figures in a certain format, but we don't actually audit the budget. That's not part of our audit. We're after the actual numbers, and obviously the prior year numbers are ours as well. Okay, if we can move on to your statement of financial position or your balance sheet. As you can see, it's broken down into financial assets, liabilities, and then you get a net financial asset number there, and then you've got something called your non-financial assets. Really everything above that net financial asset line is more or less somewhat of a liquid asset or a current liability. The important thing to note here is that the town ends up in a net financial asset position, and it's actually up about 2.4 million over the prior year. So when that number is a net financial asset versus debt and it's trending upward, you're in good financial shape. Non-financial assets, again, these are more items that are not liquid. As you can see, you've got significant number in tangible capital assets. You've got some inventory for consumption, and then a small amount of prepaid expenses. When you total of that comes to 145,393. When you add that to your net financial assets, you get what's called your accumulated surplus, which is really the most important number in your statements. Again, that number is trending upward, and it's a surplus, not a deficit. And note 13 will show you a breakdown of what that accumulated surplus looks like in a minute. So that's basically your balance sheet. Next statement is your consolidated statement of operations, or your profit and loss for the year. As you can see, you ended up with revenues of 18.7 million. That's down a little bit from prior year, just about 900,000. Expenses down though, about 600. So you end up with a small deficit or deficiency of revenue over expenses. Again, before capital revenue. Everything above that line is more from an operational standpoint. We take out the capital side of your business. That comes in a minute. So you end up with a deficit for the year of 707,197. And then the bottom of this statement is your capital revenue, which includes government transfers for capital of 3.58 million. You have some other capital revenues in there of 940,000. Small loss on disposal of tangible capital assets. So you end up with, when you add that all together with your operating deficiency, you end up with an excess of revenue over expenses of just under 3.8 million. Again, add that to your opening accumulated surplus position of 145,610,000. You end up with $149,410,000 in accumulated surplus. Again, this is your, gives you a little bit of a look at the statement of changes in net financial assets. How are those financial assets side of your balance sheet? How is that changing year over year? Again, it's impacted by your excess of revenue over expenses. We show an outflow there, acquisition of tangible capital assets of 5.6 million. Then you have to include your amortization in there of just under 4.4 million. Small loss on the sale of tangible capital assets and a little bit of proceeds on the sale of assets. So you end up with 2.7 million. And then we pull in your change in prepaid expenses and inventory for consumption. That gets you to an increase in net financial assets of 2,409,000. Again, if you went back to your balance sheet and you compared that 4,015,809 number to the 1,605,914, that's that $2.4 million difference that we just came up with. All right, we'll move to the statement of cash flows. This is always my favorite statement. It tends to tell a lot with respect to, obviously, what are your sources of cash and what are your uses of cash. Very important number to zero in on here is about a third of the way down is the 7.4 million, 7,483,613. That number is your cash flow from operations. So basically, if that number's positive, that means the core operations of the town generating positive cash flow. If that number's negative, that usually spells a little bit of trouble. That means they're going to have to borrow money to prop up operations. We all know the provincial government's talking about doing that. That's what they're going to be looking at, a different situation than you have considerably. Capital activities is a negative $5,507,000. That's cash outflow. So basically, you're spending cash on acquisition of capital. And then there's a little bit of money that came into the organization through investing, 1.2 million or 1,268,000. And then you have some financing activities. You basically you repaid some debt and you took on a little bit of additional debt. So that works out to $700,000 net. So you get, when you add all those sources and uses of cash together, you end up with a positive cash flow of $3,943,956. Add that to your opening cash position, you end up with just under $7 million in cash. And as you can see there, it is broken down. You do have some of that cash is spoken for. It's basically tied to grants that if you don't spend the money in an appropriate manner, you have to repay. So what we do is we just show that as restricted and then disclose some details with respect to that. And that's about just under $2.9 million. So really your cash and cash equivalents or unrestricted cash is about $6.9 million. The rest of the financial statements, about 20 pages of them are notes. And what I'll try and do is hit on the highlights. I will tell you that the first part of your notes are your significant accounting policies. There has been no change in your significant accounting policies. You're still recognizing revenue on a basis consistent with prior years. There haven't been any handbook changes to the public sector handbook that would require you to adopt new accounting policies. So we don't have to worry about accounting for changes in accounting policies and all that wonderful stuff. So those accounting policies are consistent and comparable to prior years. I will take you to, let's go to note 3. Thanks, Barb. Again, just shows a breakdown of that cash and cash equivalents balance. Again, shows you got about $4.2 million sitting in current accounts. You have some money sitting in investment margin accounts, about $183,000, and then the rest you have invested in redeemable GICs, just under $5.5 million, and that gives you that balance of $9.9 million. The $2.9 million I talked about being spoken for just shows a breakdown there by restriction. Again, you can see where the bulk of that money is, and obviously those projects mean a lot more to the people in this room than they do to me, but you know what that money is designated for. Next few notes are just a breakdown of some of the balances on the balance sheet. Again, the first one is just an indication of your taxes receivable. You have about $925,000 of taxes owing to the organization at December 31st. And you've set up an allowance there. That's net of an allowance of $421,463. So obviously you've got some collection issues, but some valuation issues, but again, based on our audit work, they've been properly valued and an allowance has been set up for what is deemed to be uncollectible. Note 5 is just a breakdown of your accounts receivable, again, between trade and government, and again, a small allowance has been set up against those receivables. That amount obviously very small. Inventories for resale, just a breakdown of that. Airport fuel and land held for resale, just under $2 million. Note 7 is a breakdown of your investments. Again, you have about $3.2 million tied up in long-term bonds. That's really the bulk of your investments, and a little bit in some GICs that are maturing beyond the current year. We can pass over note 8. It's just breaks down your employee benefit obligations. I don't think that's a surprise to anybody. Deferred revenue, again, the town does receive grants from the Alberta government, and when that money until that money is spent, you cannot recognize the revenue. So basically, it's deferred. And then as you incur the expenses, the revenue and the expenses are matched. So that's what that balance is there, sitting at $2.9 million at the end of the year. And again, that number matches that restricted cash amount of $2.8 million. Note 10 just shows a quick breakdown of your long-term debt, which is a $11,301,000. And then the bottom half of that note just shows what your obligations are in terms of repaying that debt, broken down into principal and interest. And your interest on long-term debt for the year amounted to $472,320. Note 11, I'm not going to get into this note in a lot of detail. Again, it's just a breakdown of your tangible capital assets by major category. Obviously, engineered structures is the bulk of your tangible capital assets, and that has a net book value of just under $97,918,000. Again, tangible capital assets. This is book value, which is basically original cost less accumulated amortization, so it doesn't represent fair market value. Fair market value could be, in the case of land or buildings, could be considerably higher. In the case of vehicles, it's probably, who knows, could be lower. Note 12, your equity and tangible capital assets is basically represented by the cost of those assets minus any debt you've borrowed against those assets. As you can see, the original cost of your tangible capital assets is $227,487,000 in the current year. Over time, you've accumulated amortization of $83 million, and then we deduct the debt you've borrowed against those capital assets, that debenture debt of $11.3 million. So you actually have your equity in your capital assets is actually on the books at $133,101,000. Note 13, in my mind, one of the key notes in your financial statements. It takes that $149 million balance on your balance sheet, breaks it down into three main categories. One, the number we just talked about, the equity in your capital assets. Then it shows you your unrestricted surplus, which is the cumulative of all your surpluses or deficits over the years. That's the money that you can do whatever you want with. And then the last piece of your accumulated surplus is your restricted surplus, and that's monies that you've set aside for specific purposes. As you can see, that's broken down into a number of reserve funds amounting to about $11.2 million. So again, that number adds to the $149,410,000 that's on your statement of financial position. Note 14 is just another variation of your accumulated surplus and just shows you basically the activity that goes through each of those components of your accumulated surplus. Again, the total adds up to the $149 million. That's the key number there. Really, this is more of an accounting transactional type note just to show you the activity that goes through those main components of your accumulated surplus. Note 15 is just a breakdown of the net municipal taxes. Again, just gives you a sense of where your tax dollars are coming from. Obviously, the bulk of your revenue coming from real property taxes. $10.8 million, that's up a bit over the prior year. Again, overall, your net municipal taxes were up a couple $100,000 over the prior year. Note 16, just a quick rundown of your government transfers. Again, you received some transfers for operating purposes from both the federal and provincial government, and then the largest amount of your transfers, obviously, for capital purposes, infrastructure funding, and that's about just under $3.6 million. Note 17 is just a breakdown of just showing another breakdown of your expenses by object. Again, some of those numbers will be more familiar to certain people in the room. Note 18 is just, obviously, you're a participant in the local authority's pension plan. That's just some information regarding that note. And we do a separate audit of your LAP that's due at the end of June, which we will divulge the results of. town's required to disclose salaries and benefits with respect to the mayor and council, and that's what this note basically does. Shows you sort of base salaries and then any benefits and allowances that the individuals receive. Again, this note's for transparency purposes. Make sure everybody is aware um, of of the expenses incurred to do your job. Note 20 just talks about your debt limit. Again, I'm sure you're all aware there's no issues here with respect to debt limits. You've got plenty of excess room to borrow if you had to. So again, that just speaks to good financial management overall. A couple of small contingencies that we have to disclose in the financial statements. I don't think those are a mystery to anybody. Commitments, again, the town has a few small commitments with respect to some electricity. Again, not going to talk about those in great detail. It does have a forward contract on natural gas as well that needs to be disclosed. Note 23 is just again a presentation note with respect to the budget. Again, the key here is that we don't audit the budget. It's an unaudited. It's unaudited. Really, the rest of the notes, I'm not going to get into them in any detail. One of them is just some segmented information. Again, we're required to disclose this under public sector, and it's just for purposes of really when these financial statements get to the government, they're looking for this segmented information. So that's basically what that is, and that is your financial statements. Any questions? No.
Thought I'd give my peers a chance to go first. Okay, if I can, then your worship, just a comment and then several questions, if you don't mind. First off, would it be fair to say you're categorizing overall the financial health of the town of Drumheller as in good financial shape?
I would say that.
And yes. Not just relative to Drumheller, but relative to...
Well, like I said, when I see net financial assets increasing, trending upward, no net financial debt, I see a healthy accumulated surplus. I see positive cash flow from operations. Those are all things that, those are similar metrics to operating a business.
Absolutely.
And they're all trending in the right direction. They're all healthy numbers. Absolutely.
Excellent. I just need some clarification on a few points. Mostly things I don't remember when we did these. I just need some clarification. So perhaps it's actually the bulk of which might come from administration, the responses. On page 2, under liabilities for long-term debt, you'll see it also in note 10, which is on page 13. Could somebody just quickly remind me what it was we borrowed for again in 2015?
Hillsview subdivision.
Thank you. In both cases?
3 year.
In both cases, the 800 and the 427?
Oh, the 427 is an older one.
Oh, is it? Okay.
That's for the East Cooley water line.
Thank you. Excellent. Then on page 3, if someone could just give me an example of what other revenue might be. It's the bottom line on revenue on page 3. Just what an example of that is, because when I see that we budgeted 86,000, but the actuals was 488,000, I'm curious about what it was we didn't get, that we budgeted so poorly for, but received significant dollars for it.
Barbara, you want to try that?
Okay. Then this one actually won't, Ray can answer the next one while you're thinking about that. Further down the page, it's in reference to the deficiency over revenue, and certainly it makes reference to it in later on as regards to the budget. We don't pass deficit budgets, never have. We wouldn't pass. It wouldn't pass. It simply wouldn't pass. And so what we do, I believe, is strategic transfers of reserves would be what we would. Is that what the other capital revenues would look like, Ray? Is that's the money that we're transferring from strategic reserves to make it so that we're not passing deficit budgets?
Barb can help me with this one, but I believe we've got the full amortization in there, and although we don't necessarily have to fund the full amortization in a given year, so I think what we're showing there is based on it being fully recovered, even though this year we may have done that, but not in every year are we able to recover our full amortization.
Right, right. It's just in the document, there's a couple of references to deficit budgets, and I think it may be a language thing, but it certainly it wouldn't be
ties
fair to
back
say that
into the
I've ever
reserves.
passed a deficit budget.
It's
And I think
it's a presentation thing.
Yeah,
too,
I thought so.
for these-
Just wanted to clarify.
for these financial statements, yeah.
And then I would highlight again for my peers, even though we didn't touch on it, everyone should be absolutely terrified by note 18 on page 19 as it relates to LAPP's 2014 unfunded pension liability at $4 billion. If you haven't noticed that lately, we have no. It says it doesn't attribute portions to the individual employers, but sooner or later, someone's going to be asked to fill the bag back up. And last but not least, I saw that our debt limits on note 20 had gone down in terms of. Oh, sorry. Oh, okay. Our overall debt limit has gone down from 29,460 in 2014 to 28 million, sorry, 28,099,000, and yet it says the calculation is based on revenue, and our revenue was up in 2015 over 2014. So I don't understand how our overall debt limit went down. Is our revenue actually down? Which page are you seeing that on?
So on page 3, so our revenue went down from 19.6
Okay.
to 18.7.
Okay, thank you.
If I could just circle back a moment to that 488,829, I believe other revenue is things such as paving, like when we do some
Fee for
paving,
service.
yeah, for the municipal or federal or provincial government and stuff.
Okay.
That would be classified as other revenue. At first I was thinking it was government transfers, but it's not. And then if I could just go down to the other capital revenues, you spoke to that as
Yep.
well. That largely in this year was the contribution for the skate park from Days, and some capital work we did on 12th Street that we billed out to
For ATCO.
Gas, yeah, or ATCO Electric, sorry.
Thank you. I appreciate that.
The work we did for ATCO was 100% recoverable from them, which is done as a service fully paid for by.
Gotcha. And just going back to note 20 on the debt limits, thanks for the clarification on that. I did read it wrong. Revenue was down, and the debt was up, so that makes sense. Ray, do you have a sense right now what the climate is for debentures right now? If we were to have to borrow this year, any idea what it's going out at?
Barb, you and I talked about that, about 2.5% over 20 or 25 years in that range.
Thank you. Those are all my questions. Thank you very much. Well done.
Anyone else? Okay, we can move on.
We want to go into the next report, and then eventually we'll want to get a motion.
Yep.
Barb, you want to throw that one up real quickly? Okay, we have it up. All right. I'm gonna again try and keep this fairly high level.
Yes. That's Cliff Johnson.
Assuming everybody read through the document. Again, this is a document that the auditing standards require us to present to management or council. But again, it's up to my discretion how much detail I'm going to go into. So again, at the end, if you have any questions, by all means, just feel free to ask me. Let's pop to, why don't we go to page 5. Just going to stop at materiality. Just to clarify, we conduct our audit using a materiality. It's based on a percentage of revenues, about 4.5%. And again, the theory of materiality is that we can't audit every dollar. It's just not possible. And obviously the cost to the entity would be extravagant. So we use in our professional judgment, we come up with a balance that we believe, if we found an error under $360,000 or less, that it would not impact the decisions of the users. Again, it's a matter of our professional judgment, but that's a number we feel represents what would be a material error. Anything over 360 would be a material error. Now, the application of materiality is more important than the number itself. And for example, if we found a $350,000 error in your prepaid expenses, we wouldn't get too excited about it. We would probably post it to what's called our summary of unadjusted differences. We would bring it to your attention. But if we found a $360,000 error on your bank reconciliation, maybe even a $50,000 error on your bank reconciliation, then we would be concerned. So it's the application of materiality more important than the number itself. So just so you know that, when we're going through your financial statements and through the records of the organization, we're looking at differences and errors a lot smaller than 360,000. It just depends where they are. We happen to find them. Just quickly on our audit approach, just go back. Our audit approach, it's a combined audit approach, so we do look at the internal controls of the town. But the bulk of our work is substantive based. So we're selecting accounts, we're selecting transactions, we're vouching to supporting documentation. We want to make sure revenue and expenses are recorded in the right amounts and in the proper periods. And same with assets. We want to make sure they exist and that they're valued correctly on the balance sheet. So we do the bulk of our work is substantive based. Again, I mentioned when I went through the financial statements, no changes in accounting policies this year. You weren't required to adopt any new accounting standards. There are a few coming down the pipe in about 2 years, 3 years. I don't see any significant impact on the accounting records of the town. It'll be more disclosure. But I will keep Ray and Barb apprised of those changes and how they'll affect the town's financial statements well in advance of adopting those policies. Stop quickly. Just to reiterate, the financial statements obviously contain some significant estimates. Primarily the ones I think of are any allowances for doubtful accounts. So obviously, management's gone to great lengths to determine whether or not specific receivables can be collected or not. But at the end of the day, that allowance is management's estimate. It's based on whatever information they've collected, their professional judgment. So that's one of the major estimates contained in the financials. Again, any write-downs of your tangible capital assets, again, would be based on any facts you've gathered and management's professional judgment. Just scroll down a bit. We'll just stop quickly at the uncorrected misstatements. Just keep going. In Appendix A, during the course of our audit, we only found 2 small misstatements. Again, they're on this schedule because they're well below our materiality of $360,000. And in the case of these particular misstatements, they were both reclass errors, so errors on the balance sheet between the liability and the asset side. So none of these misstatements affected your net surplus for the year. I think that again just speaks volumes to the quality of the accounting records when we get them. Um, so again, very small amount of uncorrected misstatements that came out of the audit this year. We had no adjusting entries with respect to the audit. 3 were made during the course of the audit, but all 3 of those entries were driven by management. They were continuing to reconcile a few accounts while we were doing the audit work, and they provided the adjustments to us. So again, we're not booking any adjustments. That means it's a clean audit. Accounting records are in good shape. So just want to reiterate that. Last thing I'll talk about real quickly is just is independence and fraud or error. Again, before we start the audit, we need to make sure we're independent with respect to the town, and then during the audit, we continue to monitor that situation. Able to report we're independent with respect to the audit both before, during, and after, so no issues there. Again, we do ask specific questions of management with respect to fraud and error. Are they aware of any irregularities? Again, we keep our eyes and ears open during the audit for anything that might indicate fraud or error. Again, we didn't come across anything that would indicate any fraud or error or irregularities of any kind. Doesn't mean they haven't happened or couldn't happen. Again, it's limited to the scope of our audit. So we're not doing a forensic audit. We're not looking at every balance or every dollar, but our standard inquiries and our audit procedures did not reveal anything of that nature. And just last but not least, again, I thought the audit went really smooth. Got great cooperation from management. We get excellent working papers. And again, I think based on the amount of misstatements we record through the course of the audit and the fact that we never record any adjustments, again, I think just speaks volumes to the quality of the accounting department and the work. So we're happy, very happy with that.
Thank you. Was there any questions or comments, Tom?
Yeah, I think this goes under internal controls. I'm not sure. It has to do with check signing.
Yeah.
Other organizations I've been a part of, when we sign checks for that organization, we also initial the check register. We also initial the invoices.
Mm-hmm.
And that's, I believe, not required for the town. Now, my understanding was the auditor that I talked to in the other organization said that gives them a higher level of confidence. And they even suggested it costs less money because they don't have to do as much or whatever. I just wondered if you could comment on that.
Well, that's not a bad idea. I sit on the board of an organization, and one of the prior to my involvement on the board, no one reviewed the checks. All the checks were signed by an automatic signing machine, so nobody was reviewing invoices, supporting documentation for checks. So when we got in, we said, somebody needs to review the checks and sign them. So what we do is we review all the backup for the checks. I don't specifically sign any of that backup, and I don't sign the check register. But again, it should be the level of controls you want to implement should be based on sort of whatever comfort level you have. But that is an excellent control, and if it makes everybody comfortable, then I would suggest you do it. I have, again, controls vary from very good to marginally acceptable, and when we reviewed your treasury cycle and all of your bank reconciliation, there's good top-down controls there, but that's one more control that you could add absolutely to enhance that.
Just as a quick comment, if I could, just based on past practice, although we could refine it as was discussed here, having the mayor and deputy mayors at different times signing the checks. We see that as a bit of a mini audit, and it just helps in terms of improving the comfort level by having them go through all the checks and being aware of those. And if something unusual comes up, they ask the question, and it's up to administration to provide a proper answer.
I would, if you want to add that extra control, I think that's an excellent idea if you want to add that additional level of review.
Jay?
Thank you, Worship. I just wanted to point out, I think I've been around long enough that this is our third auditor that we would have been involved with. Second or third. Either way, I don't remember the other reports being quite as detailed. I really appreciate some of the information that's included here. I mean, no material misstatements and no fraud would be the minimum standard on the bar. But to find out the other parts that, the significant difficulties or disagreements part. I mean, that's information I don't recall ever having been provided with before. And it speaks very well to the organization. I mean, the detail that's here, just not the internal controls, but also what it was like to work with our staff. That's feedback that I don't recall having received before. And of course, it's excellent. But that's great reinforcement of what we may have believed already. So I just wanted to point that out. And thank you for your thoroughness.
Anyone else? If we could have a motion to approve the 2015 financial statement as presented. Cheryl? Thank you. And a seconder? Jay? Any other questions or comments? Seeing none? All in favor? Motion's carried. And with that, we can adjourn this meeting and we can go into our Committee of the Whole meeting. First up, we have to swear in Tara McMillan to be sworn in for Deputy Mayor for the months of May and June. Tara?